Today's U.S. jobs report is more than just a headline. It's a pulse check on the economy, a signal to the Fed, and a potential pivot point for your portfolio. Let's break down what to watch for and how to act accordingly. We'll cover 6 crucial points in today's report, then translate them into actionable steps for your portfolio. Plus, we've got tactical moves that apply no matter the outcome, and stick with me to the end. I'll share 2 key metrics you should be tracking right now. They can help you position for success, whatever the jobs report reveals. All right, let's get into what to watch. Number 1, non-farm payrolls, or NFP. Simply put, this is the report's headline act. It shows how many jobs were added in the U.S. economy outside of farming. The street is expecting 75,000 jobs added in September following a revised 73,000 in August. Now here's the twist. The Fed isn't at all concerned about a soft jobs number. In fact, they kind of want to see it because it confirms their view that the labor market has cooled, and we do and have this so-called wage price spiral. It's basically, if the number comes in below expectations, let's say 50,000 or even 25,000, it doesn't rattle the Fed much. They're looking at this as a good thing. At a big miss, say 100,000 fewer jobs added, could freak out investors because it would suggest the economy is stalling, not just cooling. So what do you need to know? Well, a weak print would reinforce the idea that the Fed is done with rate hikes and might start cutting rates soon. That'd make bond yields fall. Safe haven assets like gold might shine, and growth stocks, especially in tech and discretionary, could rally since they'd benefit from falling yields and cheaper borrowing costs. On the flip side, surprisingly strong jobs number could scare the markets into thinking the Fed might not cut rates as soon as they expected. So think of it like this. If everyone is pricing in no rate cuts for the rest of the year, and then suddenly the jobs report comes in way stronger than expected, well, you might see some panic selling as people realize the Fed might have to keep rates higher for longer. Number 2, the unemployment rate. Economists expect the unemployment rate to tick up to 4.3% from 4.2%. Now here's the caveat. An increase in the unemployment rate doesn't always mean bad news. It could signal that businesses are getting cautious and are letting go of workers before demand tanks. That's not necessarily a sign of desperation. It's almost like preemptive strike to save money. So why is this important? Well, if businesses are firing people because they anticipate a slowdown, it means they're not super confident about the future. They're essentially betting that it's better to have fewer workers now and save money than to keep staff on and burn cash when demand drops. For investors, it's a reminder to stay flexible. Don't get caught off guard. Think about ways you can quickly adapt your spending and investing if things change. Number 3, average hourly earnings, also known as wage growth. Economists forecast a monthly increase of 0.3% and a yearly trend cooling to 3.7%, down from 3.9%. Here's the deal. Wage growth is closely watched by the Fed because it is a key factor in determining whether prices will keep rising. If wages go up, workers have more money to spend, which could lead to higher prices. So if wage growth stays sticky, even if it's not super high, the Fed might think twice about cutting rates too soon. It's like they're trying to be patient, but it's hard when wages don't cooperate. By the way, if you're enjoying this analysis and want to stay updated with our weekly investment strategies, don't forget to show your support. It really helps us keep you in the loop on market insights. Number 4, labor force participation. This refers to the percentage of the working age population that is either working or actively seeking a job. It recently hit a 31-month low. Here's what you need to know. A further drop in labor force participation could indicate that people are giving up on finding a job because the economy isn't offering enough opportunities. It's a sign of structural weakness, meaning the economy itself is having trouble, not just that people are going through a temporary rough patch. So why should you care? Well, if more people stop looking for work, it could mean that companies won't be competing as much for employees, which might take the pressure off wages and could even push some of them to cut prices. That's not great for the economy, and it could affect your investments. Number 5, revisions to prior months. The jobs report isn't just about what happened last month. It also includes updates on previous months. In August, payrolls were revised down by 258,000 jobs, mostly due to a whopping 200,000 drop in government jobs. These revisions are crucial because they give us a clearer picture of what's really been happening in the labor market. If July gets revised lower, It would confirm that there's deeper weakness under the surface and the initial numbers weren't really capturing it accurately. Number 6. The sector breakdown. Let's look at where job gains or losses are concentrated. So what you want to watch for? Well, manufacturing lost 36,000 jobs over 3 months, suggesting persistent weakness in this sector. Retail and seasonal hiring plans have also hit record lows, hinting at softer consumer spending. Keep an eye on these areas because they can offer clues about which sectors might be worth investing in, and which ones you might want to avoid. Now let's talk about how to use all this info to manage your portfolio. Whether the report beats expectations, misses, or comes in mixed. If it's weak, here's what you need to know. First, rate cut odds will go up. Bond yields tend to fall when the report misses because it reduces expectations for rate hikes. Growth stocks like tech and consumer discretionary usually rally on lower yields and expectations for cheaper borrowing costs. Second, gold tends to shine as investors seek a safe haven. Third, high-quality growth stocks with strong earnings revisions often perform well during a rate cut cycle. Think companies like Nvidia, Salesforce, and Adobe. You could consider adding exposure to these areas through ETFs like QQQ, VGT, or DOC. Now, if the report beats expectations, the Fed is likely to stay hawkish. Bond yields may rise because the market will price in higher interest rates for longer. Value stocks, financials, and energy tend to do well in this environment. So consider adding the Energy Select Sector Spider Fund, XLE, the Financial Select Sector Spider Fund, XLF, or the Vanguard Value ETF, VTV. Finally, if the report is mixed, volatility spikes as traders parse the details and try to figure out what it all means. This is where having a diversified portfolio and staying hedged with options or inverse ETFs can help buffer against sudden shifts. And here are 2 tactical moves you can make today, regardless of the jobs report. First, if your portfolio is overweight U.S. cyclicals, consider trimming some positions to rebalance. You could look into adding exposure to international growth, particularly in emerging markets, as the U.S. labor market shows persistent weakness. ETFs like VXUS or VWO might be interesting. Second, monitor PEG ratios and earnings revisions, especially in retail and manufacturing. Companies that are doing better than expected might offer good opportunities, but it's essential to keep an eye on those who aren't meeting expectations. I hope this helps. And remember, investing involves risk. Past performance doesn't guarantee future results. This isn't financial advice, just my own journey of sharing what I'm learning. Let me know your thoughts and what questions you have. And thanks for being part of this community. If you find this helpful, remember to smash that subscribe button. I would really appreciate it.